Welcome back to the channel. Today, we're going to break down RTX Corporation like never before. We'll explore the good, the bad, and the interesting metrics that paint a vivid picture of what's really going on with this company. So, grab your popcorn and let's dive right in. First up, the price-to-earnings ratio (P/E). For the trailing 12 months, RTX has a P/E of 20.26. This is slightly higher than its 5-year average of 18.86. What does this mean? Well, RTX has been a bit pricier compared to its past. But wait, there's more. Looking forward, the P/E ratio is expected to be 17.12. This suggests that the market anticipates better earnings ahead, making the stock slightly cheaper on future earnings. Intriguing, right? Next, we have the P/G ratio at 1.40. This ratio takes into account the company's growth rate, and a P/G around 1 typically indicates that a stock is fairly valued. RTX's P/G of 1.40 suggests it's a bit overvalued when we factor in expected growth. Now, this might surprise you. Insider ownership at RTX is just 0.1%. That's right, practically peanuts. This could mean insiders aren't heavily invested in the company's stock, which might raise a few eyebrows. RTX's return of equity stands at 5.22%, return of assets at 2.16%, and return of invested capital at 5.07%. These returns show how efficiently the company is using its equity, assets, and capital to generate profits. They aren't jaw-dropping numbers, but they give us a peek into the company's profitability. RTX boasts an EPS of 5.17. What's exciting here is the projection for the next 5 years, a whopping 14.51% growth. It seems like RTX is gearing up for some strong earnings growth, folks. But let's not get too excited just yet. The EPS has had a bumpy ride over the last decade. Positive growth until 2019, then a significant drop in 2020 due to an increase in shares outstanding. Although there was some recovery, the compound annual growth rate over the past decade stands at -3.03%. Ouch! The free cash flow per share has been inconsistent as well. Over the last decade, the CAGR is -1.35%. Not the kind of trend we love to see. For all you dividend lovers, RTX offers a yield of 2.41%. Plus, they've grown their dividend by an average of 5.16% annually over the last 10 years. Not too shabby. RTX's operating margin is 4.7%, and the profit margin is slightly higher at 4.9%. These margins indicate the company's ability to convert revenue into profit. Again, not the highest, but it shows steady profitability. Revenue and earnings have been flat over the past 8 years. This stagnation hasn't stopped the market price from fluctuating, though RTX has underperformed compared to VO in total return over the last 5 years. Debt alert! RTX has a debt/EBITDA ratio of 4.60 and a debt/free cash flow ratio of 6.73. These numbers suggest that the company is quite leveraged, which can be risky. Over the past year, RTX has had an average price return of 7.24%. Steady, but not spectacular. RTX's market cap stands tall at $138.67 billion. That's a big number, showing the company's substantial size in the market. Finally, analysts predict that RTX's price will hit $107.10 in the next 12 months, representing a modest upside of 2.22% from the current price of $104.77. However, my fair value estimate is $103.57, which is close to the current price and analyst expectations indicating a fair valuation. So, what's the verdict? RTX has some promising growth prospects, especially with the EPS forecast, but there are concerns with its past performance, debt levels, and insider ownership. It seems like a mixed bag, and whether it's a hidden gem or overhyped depends on your investment strategy and risk tolerance. If you found this deep dive helpful, give us a thumbs up and subscribe for more financial insights. Drop your thoughts in the comments below. Is RTX in your portfolio? Until next time, happy investing!